Good morning, class. Today we're diving into one of the most fundamental tools in accounting and finance, the balance sheet. By the end of this lecture, you'll understand not just what a balance sheet is, but why it's absolutely critical for understanding any business. What is a balance sheet? Let me start with a question. If you wanted to know whether you could afford to buy a car, what would you need to know? You'd need to know what you have, your savings, investments, maybe the value of things you could sell. And you'd need to know what you owe. Credit card debt, student loans, rent due. The difference between these would tell you your true financial position. A balance sheet does exactly this for a business. It's a financial statement that captures everything a company owns and everything it owes at a single moment in time. Unlike an income statement that shows performance over a period, a balance sheet is like a photograph. It freezes the financial position at one specific date. The fundamental equation, here's the cornerstone principle you must remember. Assets equal to liabilities plus equity. This equation is absolute. It will always balance. Why? Because every asset a company has must have been financed somehow, either by borrowing money creating a liability or by owner investment creating equity. Let me illustrate this. Imagine you start a coffee shop. You put in $50,000 of your own money and borrow $30,000 from the bank. You now have $80,000 in cash and an asset. But notice, this $80,000 asset equals your $30,000 liability plus your $50,000 equity. The equation balances from day one. Understanding assets. Assets are economic resources that will provide future benefit. We divide them into two categories. Current assets are like the cash in your wallet and the groceries in your fridge. They'll be used up or converted to cash within a year. For our coffee shop, this includes cash in the register and bank coffee beans and milk and inventory money customers owe you for catering orders. Non-current assets are the long-term investments that help you generate revenue. For our coffee shop, the espresso machine, the building if you own it, the renovation you did to create that cozy atmosphere. Here's a key insight. We list assets in order of liquidity. Cash comes first because it's already liquid. The building comes last because try selling a building quickly. It takes months. Understanding liabilities. Liabilities represent obligations, promises to pay someone else. Again, we have two categories. Current liabilities must be paid within a year. Next month's rent, the invoice from your coffee supplier, wages you owe your baristas for last week. Non-current liabilities are long-term obligations. The 5-year loan for your espresso machine, the 20-year mortgage on your building. Notice something important. The classification between current and non-current isn't about the type of debt, but the timeline. If you have a 5-year loan, the portion due this year is current, while the rest is non-current. Understanding equity. Equity is the residual, what's left for the owners after all debts are paid. Think of it as the business's net worth. If you liquidated everything and paid all debts, equity is what you'd walk away with. Equity increases in two ways. Owners invest more money. The business earns profits and doesn't distribute them all. And it decreases when the business has losses. Owners take money out, dividends, or withdrawals. Reading the story. Now here's where it gets interesting. A balance sheet tells a story about the business. Let me show you how to read between the lines. High cash, but high debt. Maybe they just took out a loan and haven't spent it yet. Lots of inventory, but low cash. They might be struggling to sell their products. Assets mostly financed by equity rather than debt. This company is conservatively financed, less risky, but possibly missing growth opportunities. Current assets less than current liabilities. Red flag. They might struggle to pay bills coming due. The interconnection, remember. The balance sheet doesn't exist in isolation. It connects to other financial statements. When you earn profit from the income statement, it increases retained earnings and equity. When you buy equipment with cash from the cash flow statement, you're just swapping one asset for another. Practical application. Let's say you're evaluating whether to invest in a company. The balance sheet helps you answer critical questions. Can they pay their bills? Compare current assets to current liabilities. How leveraged are they? Compare total debt to equity. Are they asset heavy or asset light? Look at the composition of assets. How efficiently do they use their assets? This requires comparing to the income statement. Common misconceptions. Before we wrap up, let me address some common mistakes I see. First, book value doesn't equal market value. The balance sheet shows historical costs, not what assets could sell for today. Second, not everything valuable appears on the balance sheet. The brilliant employees, the brand reputation, the loyal customers, these intangible assets often don't show up. Third, a strong balance sheet doesn't guarantee success. A company can have lots of assets and still fail if it can't generate profits. Conclusion. The balance sheet is like a financial health report. It won't tell you everything about a business, but you can't truly understand a business without it. Master this foundation, and you'll be able to peer into any company's financial situation and understand its strengths, weaknesses, and potential. For next class, I want you to find a real company's balance sheet and identify its largest asset, largest liability, and calculate what percentage of assets are financed by debt versus equity. We'll discuss what these patterns tell us about different business models. Any questions before we wrap up?